Picture this. It's April 1861 and the Confederate Army has just fired the first shots at Fort Sumter. The Union is hemorrhaging money faster than blood on the battlefield. Treasury Secretary Salmon Chase is desperate. The federal government needs $150 million immediately to fund the largest military operation in American history. But every major bank on Wall Street has refused to help. Then 8 Jewish immigrant brothers from Bavaria step forward with a plan so audacious, so brilliant, that it would not only save the Union, but transform them into the most powerful banking dynasty America had ever seen. The Seligman brothers didn't start as bankers. They started as peddlers, walking hundreds of miles through American wilderness with packs on their backs selling needles, thread and fabric to settlers who hadn't seen civilization in months. They arrived in America with nothing but the clothes on their backs and dreams bigger than the continent itself. But what nobody knew was that these 8 brothers possessed something more valuable than capital or connections, an unbreakable bond and a financial genius that would reshape American capitalism forever. While other immigrant families scattered across the country seeking individual success, the Seligmans operated as a single economic organism, sharing resources, information, and opportunities across a network that spanned from New York to San Francisco to London. When Abraham Lincoln's government faced bankruptcy and potential collapse, the Seligman brothers didn't just provide money. They invented entirely new financial mechanisms that enabled the North to outspend the Confederacy by a ratio of 6 to 1. They created the bond markets that funded Union victory. They established the international relationships that prevented European powers from supporting the South. They built the financial infrastructure that held America together during its darkest hour. Without the Seligman brothers, there might not be a United States of America today. The Confederate States would likely have achieved independence, creating 2 separate nations with completely different economic and social systems. Slavery might have persisted for decades longer. The Industrial Revolution that made America a global superpower might never have occurred. But the brothers' influence extended far beyond the Civil War. They financed the Transcontinental Railroad that connected the coasts. They funded the massive immigration waves that built American cities. They created the international banking relationships that made New York a global financial center. They were instrumental in virtually every major economic development that transformed America from an agricultural nation into an industrial superpower. This isn't just another immigrant success story. This is the story of how 8 brothers saved the Union, transformed American capitalism, and built a financial empire that influenced world events for over a century. This is the story of how peddlers became power brokers, how immigrants became patriots, and how family loyalty became the foundation for American financial dominance. This is the complete untold story of the Seligman brothers, from Bavarian poverty to American financial royalty. Chapter 1: Humble Origins. The morning of March 15, 1838, marked the end of everything the Seligman family had ever known, and the beginning of what would become the most remarkable financial dynasty in American history. David Seligman stood in the doorway of his modest weaving workshop in Baiersdorf, Bavaria, watching his eldest son Joseph disappear down the dusty village road carrying everything he owned in a single canvas sack. That sack contained 2 changes of clothes, a small Hebrew prayer book that had belonged to Joseph's grandfather, and exactly 100 marks in Bavarian currency, roughly equivalent to 25 American dollars. It represented the family's entire accumulated savings from 20 years of weaving work, and it would have to sustain Joseph during the 6-week ocean crossing to New York and his first months in America. The decision to send Joseph to America hadn't been made lightly. The Seligman family had lived in Baiersdorf for over 2 centuries, building modest prosperity through careful craftsmanship and conservative financial management. David's father and grandfather had been respected members of the small Jewish community, contributing to synagogue maintenance and participating in the village's limited economic life. But by the 1830s, everything was changing in ways that made traditional Jewish life in Bavaria increasingly impossible. The Industrial Revolution was destroying cottage industries like weaving. Political movements promoting German nationalism were creating systematic discrimination against Jewish families, and economic opportunities for young men were disappearing faster than traditional crafts could adapt to modern competition. David understood that his 8 sons faced a choice between poverty in Bavaria or potential opportunity in America. There was no middle path. The traditional occupations that had sustained Jewish families for generations were becoming economically obsolete, and the political environment was becoming increasingly hostile to Jewish advancement. The village of Bayersdorf itself told the story of these changes. Once a thriving center for traditional crafts, it was gradually being economically marginalized as industrial centers in Munich and Nuremberg attracted business and population. The weekly markets that had provided income for local craftsmen were shrinking as mass-produced goods from factories undercut traditional artisanal production. For Jewish families, the situation was particularly difficult. Bavarian law still restricted Jewish occupations, residence patterns, and even family formation. Jews couldn't own land in most areas, couldn't join craft guilds, and faced legal limits on the number of Jewish families allowed to live in any given community. These restrictions, combined with economic modernization, created a situation where Jewish families had limited options for economic survival. Joseph Seligman's journey to America began with a 200-mile walk to the port of Hamburg, where emigrant ships departed regularly for New York. He couldn't afford coach fare, so he walked the entire distance over 2 weeks, sleeping in fields and barns, eating bread and cheese that he had packed for the journey. The Hamburg Immigrant District was a shocking introduction to the realities of 19th-century immigration. Thousands of people from across German-speaking regions crowded into cheap lodging houses, waiting for ship departures while being systematically cheated by merchants who sold them overpriced supplies and worthless advice about American opportunities. Joseph spent 3 weeks in Hamburg, learning English phrases from other emigrants and studying maps of America that showed him the enormous scale of the country he was planning to enter. He realized that success in America would require thinking on a continental scale that was completely different from the village-based economic relationships he had known in Bavaria. The ship passage itself was a 6-week ordeal that would have broken less determined individuals. Joseph traveled in steerage, the cheapest accommodation available, sharing space with over 300 other emigrants in conditions that were barely habitable. Disease was rampant, food was spoiled, and the ship's crew treated steerage passengers with contempt that bordered on cruelty. But Joseph used the voyage to begin building the relationships that would eventually become crucial to his family's success. He identified other German-speaking emigrants who were planning to establish businesses in America, learning about their plans and beginning to understand the economic opportunities that different regions might offer. Most importantly, he began developing what would become the Seligman family's signature approach to business, viewing every relationship as potentially valuable and maintaining connections across a network of mutual obligations and shared interests. While other emigrants focused on individual survival, Joseph was already thinking about how to create economic relationships that could benefit multiple parties simultaneously. When Joseph finally arrived in New York Harbor on July 4, 1837, he was stunned by the scale and energy of American economic activity. New York was already the largest city in America, with over 300,000 people and commercial activity that exceeded anything he had experienced in Europe. Ships from around the world crowded the harbor, bringing goods and people from every continent. But Joseph also immediately recognized that New York's economic opportunities came with intense competition that would make success difficult for immigrants with limited capital and connections. The established merchant families who controlled New York commerce had resources and relationships that would be impossible for individual immigrants to challenge directly. His solution was characteristically innovative. Instead of trying to compete in New York's saturated markets, he would establish operations in smaller cities where his family's eventual network could provide competitive advantages that larger established businesses couldn't match. Joseph's first destination was Lancaster, Pennsylvania, a city of about 8,000 people with a large German immigrant population that needed goods and services that established American businesses weren't providing effectively. Lancaster was also positioned on transportation routes that would enable efficient supply operations serving multiple regional markets. He used his remaining $75 to rent a small storefront and purchase initial inventory of needles, thread, fabric, and other basic goods that German immigrant families needed but had difficulty finding from American suppliers. His prices were competitive, his service was personal, and his inventory was specifically selected for his customer base. But Joseph's real innovation was his credit and information systems. Unlike established American merchants who demanded cash payment, Joseph was willing to extend credit to customers whose character and prospects he could evaluate personally. He also maintained detailed records of local economic conditions, customer needs, and supply opportunities that he could share with his brothers as they joined him in America. Within 6 months, Joseph's Lancaster operation was generating enough profit to finance his brother James's immigration. By early 1839, James had established similar operations in Montgomery, Alabama, where the cotton economy was creating demand for manufactured goods that northern suppliers couldn't meet efficiently. The brothers' correspondence during this period reveals their systematic approach to building a continental business network. They shared information about local market conditions, coordinated inventory purchases to achieve bulk pricing advantages, and began developing the financial relationships that would eventually enable them to move capital and credit across vast distances. More importantly, they were beginning to understand something that other immigrant businesses missed. America's rapid territorial and economic expansion was creating opportunities for businesses that could operate across multiple regions simultaneously. Individual local businesses might prosper temporarily, but sustainable success required continental thinking and family-based coordination that could survive economic downturns and competitive pressures. By 1840, the Seligman brothers had established the foundation for what would become the most powerful financial network in America. Their modest dry goods operations were generating steady profits. Their family relationships were enabling business coordination that competitors couldn't match, and their understanding of American economic development was positioning them to capitalize on opportunities that others couldn't recognize. They were about to discover that their family-based approach to business would prove ideally suited to the challenges and opportunities of America's westward expansion, gold rush economy, and eventual Civil War crisis that would transform them from immigrant merchants into the financial architects of American development. Chapter 2: American Dreams. By 1845, the transformation was remarkable and undeniable. What had started as Joseph Seligman's desperate attempt to escape Bavarian poverty had evolved into the most sophisticated commercial network operating in American frontier regions. 5 Seligman brothers now operated businesses spanning from Pennsylvania to Alabama to Missouri, generating combined annual revenues that exceeded $200,000, making them wealthier than most established American merchant families. But the numbers told only part of the story. What made the Seligman operation unprecedented wasn't just its geographic scope or financial success, but the revolutionary business model they had developed based on absolute family loyalty and shared information that enabled them to anticipate market trends and economic developments before their competitors understood what was happening. Jesse Seligman's operation in St. Louis exemplified this approach. Positioned at the confluence of the Missouri and Mississippi rivers, St. Louis was rapidly becoming the primary staging area for westward expansion. Thousands of settlers passed through the city every month, purchasing supplies for overland journeys to Oregon, California, and the territories that would eventually become the Western United States. Traditional suppliers focused on providing standard manufactured goods at competitive prices. Jesse recognized that settlers needed something more valuable. Customized supply packages that included everything necessary for specific types of journeys, backed by information about trail conditions, weather patterns, and economic opportunities in different Western regions. His store became legendary among westward migrants, not just for the quality of its supplies, but for Jesse's encyclopedic knowledge of Western conditions that he had accumulated through systematic correspondence with customers who had made successful journeys and established businesses in frontier areas. Here's how the system worked. Settlers who purchased supplies from Jesse would agree to send regular reports about trail conditions, business opportunities, and local economic developments in exchange for discounted goods and ongoing credit arrangements. Jesse would compile this information into detailed intelligence reports that he shared with his brothers, enabling the family network to identify business opportunities months or even years before they became apparent to other merchants. This information network provided extraordinary advantages. When gold was discovered at Sutter's Mill in California in January 1848, news didn't reach the East Coast through official channels until September. But Jesse had received detailed reports from customers about unusual mining activity as early as March, enabling the Seligman brothers to begin coordinating supply operations for the inevitable gold rush before most businesses knew it was happening. Their response to the California gold rush demonstrated the power of their family-based business model on a continental scale. While other merchants were scrambling to understand what the gold discovery meant for their businesses, the Seligman brothers implemented a coordinated strategy that positioned them to capture enormous profits from the massive population movement that would transform the American economy. William Seligman, who had joined his brothers in 1846, was dispatched to California with a substantial inventory of mining equipment, tools, and supplies that the brothers had purchased at wholesale prices in eastern markets. He established operations in San Francisco just as the city was beginning its transformation from a sleepy village into the commercial center of the gold rush economy. Simultaneously, Jesse expanded his St. Louis operations to serve as the primary supply center for overland travelers heading to California. James coordinated cotton trading operations in Alabama to generate the capital needed for inventory purchases. Joseph managed eastern supplier relationships to ensure reliable access to manufactured goods. And Henry, who had immigrated in 1847, established operations in New York to handle international trade and financial relationships. This coordinated approach enabled them to capture profits at every stage of the gold rush economy. They earned retail margins on supplies sold to prospectors in California. They captured transportation markups on goods shipped from eastern markets. They generated trading profits by timing their purchases to take advantage of seasonal price fluctuations. And they accumulated detailed intelligence about California's economic development that enabled them to identify investment opportunities beyond simple retail trade. But perhaps most importantly, the gold rush taught the Seligman brothers that the greatest profits came not from participating in speculative bubbles, but from providing essential services that successful speculation required. While thousands of prospectors lost everything searching for gold, the brothers built sustainable businesses providing the supplies, financing, and information that made successful mining possible. William's San Francisco operations quickly expanded beyond simple retail trade to include banking services that other businesses couldn't provide. He began accepting gold dust as deposits, providing credit to established mining operations, and facilitating payments between California businesses and suppliers in eastern markets. These banking services grew out of practical necessity rather than strategic planning. California's rapid economic growth had created a chaotic financial environment where standard commercial transactions were extremely difficult to complete. Banks were virtually non-existent, currency was scarce, and the legal framework for commercial relationships was poorly developed. William discovered that his family's network provided unique capabilities for managing these financial challenges. The brothers could move funds between different regions more efficiently than established banks. They could evaluate credit risks in frontier markets where traditional assessment methods didn't work, and they could facilitate complex transactions that required coordination across multiple markets simultaneously. By 1850, William was essentially operating as a private banker for much of San Francisco's legitimate business community. His operations included currency exchange, commercial lending, gold storage and transportation, and even early forms of investment banking for businesses seeking expansion capital. The profits from these financial services exceeded anything the brothers had earned from retail trade. More importantly, banking relationships provided access to information about California's economic development that enabled them to identify investment opportunities in real estate, transportation, and emerging industries. The brothers' success in California attracted attention from other immigrant families who attempted to replicate their business model. But the Seligman approach couldn't be easily copied because it depended on family relationships that took years to develop and required levels of mutual trust that weren't available to business partnerships between unrelated individuals. The 8 brothers shared information freely, moved capital between their operations without formal agreements, and made business decisions based on family interests rather than individual profit maximization. This approach enabled them to pursue long-term strategies that individual businesses couldn't afford and to take calculated risks that partnership arrangements couldn't support. By 1852, the Seligman family network included profitable operations in 6 different regions, managed banking relationships with hundreds of businesses, and had accumulated capital reserves that positioned them to pursue opportunities beyond traditional commercial trade. Their combined net worth exceeded $500,000, equivalent to roughly $15 million today, making them one of the wealthiest immigrant families in America. But their most valuable asset wasn't their accumulated wealth. It was their proven ability to identify and capture opportunities created by America's rapid economic development. They had demonstrated that family-based business networks could compete successfully against established American firms, and that systematic information sharing could provide sustainable competitive advantages in rapidly changing markets. The brothers were beginning to understand that their ultimate success would depend on positioning themselves as essential facilitators of American economic growth, rather than simply successful participants in existing markets. They wanted to build financial infrastructure that other businesses would depend on, rather than just competing with those businesses for market share. This strategic insight would prove crucial as America approached the crisis that would test the survival of the Union itself. The Seligman brothers' proven ability to coordinate complex operations across vast distances and provide financial services that established institutions couldn't match would soon make them indispensable to the federal government's desperate attempts to finance the largest military operation in the nation's history. Chapter 3. Brotherhood Network. The letter that arrived at Joseph Seligman's New York office on November 15, 1856, contained news that would fundamentally alter the trajectory of American business history. Written in William's careful handwriting from San Francisco, it contained a single sentence that captured the essence of what the Seligman brothers had achieved during their first 20 years in America. We are no longer merchants. We have become a financial institution. The transformation had been gradual but undeniable. What had started as a collection of individual dry goods stores had evolved into an integrated financial network that provided banking services, commercial credit, investment opportunities, and market intelligence to thousands of businesses across the American continent. The Seligman brothers had essentially created the first coast-to-coast financial institution in American history. Their success was built on a revolutionary approach to family business that would have been impossible for non-immigrant families to implement. While established American merchant families typically divided their wealth among children who pursued individual careers, the Seligman brothers maintained absolute economic unity that enabled them to pursue strategies requiring continental coordination. Here's how their system actually worked in practice. Each brother managed operations in his assigned region with complete authority over local business decisions, but all major financial commitments required consultation with the family network through an extensive correspondence system that connected their operations in real time. Daily letters moved between New York, Pennsylvania, Alabama, Missouri, California, and eventually London, containing detailed reports about local market conditions, customer credit evaluations, investment opportunities, and strategic recommendations. This information sharing enabled each brother to make decisions based on continental economic conditions rather than simply local market factors. The correspondence records that survive from this period reveal the extraordinary sophistication of their coordination mechanisms. They had developed standardized accounting systems that enabled precise comparisons of profitability across different regions. They maintained detailed customer databases that tracked credit histories, purchasing patterns, and business relationships across their entire network. They even created early forms of risk management that distributed potential losses across multiple operations to prevent individual failures from threatening the overall family enterprise. But perhaps most importantly, they had established what they called capital pooling, a system where profits from all operations were combined and then redistributed based on strategic priorities rather than individual business performance. This approach enabled them to pursue opportunities requiring substantial capital investments that individual operations couldn't afford, while maintaining financial support for operations experiencing temporary difficulties. Isaac Seligman's banking operations in New York demonstrated the power of this coordinated approach. By 1855, he was managing financial relationships for businesses throughout the eastern United States, providing commercial lending, foreign exchange services, and investment advice that established banks couldn't match. His competitive advantages came directly from the family network. While traditional banks had to rely on local information for credit evaluations, Isaac could access detailed intelligence about customers' business activities across multiple regions. When a New York merchant applied for credit to finance cotton purchases in Alabama, Isaac could verify the applicant's reputation through James's Alabama operations and assess market conditions through the family's comprehensive intelligence network. This superior information enabled Isaac to make credit decisions more quickly and accurately than established banks, while charging fees that reflected the reduced risk provided by the family's comprehensive customer knowledge. By 1856, his lending operations were generating annual profits that exceeded $100,000 while maintaining default rates below 2%, performance that exceeded even the most conservative established banks. Similarly, Henry Seligman's European operations demonstrated how family coordination could capture opportunities that individual businesses couldn't access. Based in London since 1854, Henry had established relationships with British and continental banks that enabled the family to facilitate international trade financing that American businesses desperately needed but couldn't obtain from domestic sources. The American economy in the 1850s was experiencing unprecedented growth that required enormous capital imports from European investors. But most American businesses lacked the international relationships and credit evaluations that European banks demanded for commercial financing. Henry's operations bridged this gap by using the family's American business intelligence to evaluate credit risks for European lenders while using European capital to finance American business expansion. This international arbitrage was extraordinarily profitable because it captured the premium associated with connecting capital-rich European markets with opportunity-rich American markets. More importantly, it positioned the Seligman family as essential intermediaries for the international financial relationships that American economic development increasingly required. Abraham and Leopold Seligman, the youngest brothers, had joined the family operations by 1857 and were assigned to develop specialized capabilities that the network needed but couldn't obtain from existing sources. Abraham focused on government relationships, learning how federal, state, and local governments managed their financial requirements and identifying opportunities for private businesses to provide services that government agencies couldn't handle internally. Leopold specialized in what would eventually become investment banking, helping established businesses raise expansion capital by selling equity or debt securities to wealthy investors. This was a completely new field in American finance that required combining detailed knowledge of specific industries with sophisticated understanding of investor requirements. Together, the 8 Seligman brothers had created capabilities that exceeded what any established American financial institution could provide. They could evaluate credit risks across multiple regions, facilitate international trade financing, provide government financial services, arrange business expansion capital, and coordinate complex transactions requiring activities in different markets simultaneously. But perhaps their most valuable capability was strategic intelligence. their systematic collection and analysis of economic information that enabled them to anticipate market trends and identify opportunities before they became apparent to other businesses. The family's correspondence network had evolved into what was essentially the first private economic intelligence service in American history. By 1857, they were regularly advising government officials about economic conditions in different regions, consulting with railroad companies about route planning and financing, and providing investment recommendations to wealthy individuals who lacked access to reliable market information. These advisory relationships generated substantial fee income while providing access to decision-makers who controlled enormous financial resources. The Panic of 1857 provided the ultimate test of their family-based business model. The economic crisis began with the failure of the Ohio Life Insurance and Trust Company in August and rapidly spread throughout the financial system, causing bank failures, business bankruptcies, and unemployment that exceeded 10% in many regions. While most financial institutions struggled to survive by liquidating assets and calling in loans, the Seligman brothers implemented a coordinated response that actually strengthened their market position. Instead of reducing their operations, they used the family's accumulated capital reserves to acquire distressed assets from desperate sellers at fractions of their pre-crisis values. Their strategy was based on a sophisticated analysis that other businesses missed. The crisis was caused by excessive speculation and over-leveraging rather than fundamental problems with American economic growth. The productive capacity of American agriculture and industry remained intact, meaning that asset values would recover once speculative pressures subsided. The brothers purchased substantial interests in railroad companies, mining operations, real estate developments, and manufacturing businesses that panicked sellers were abandoning for immediate cash. They also expanded their lending operations to provide credit for businesses that couldn't obtain financing from traditional banks. This contrarian approach required extraordinary financial discipline and risk management, since they were essentially betting their accumulated wealth on their analysis of economic fundamentals. But their family-based decision-making process enabled them to maintain strategic focus during a period when most businesses were paralyzed by uncertainty and fear. When the economy began recovering in 1859, the Seligman brothers emerged from the crisis significantly wealthier and more influential than before. Their crisis investments had generated spectacular returns. Their lending operations had captured market share from failed competitors, and their reputation for financial stability had attracted new customers who had lost confidence in established institutions. More importantly, the crisis had demonstrated their unique ability to coordinate complex financial operations during periods of maximum stress and uncertainty. This capability would prove invaluable when the American government faced a crisis that threatened the survival of the Union itself and required financial innovations that no existing institution could provide. The Seligman brothers were about to discover that their family-based financial network was perfectly positioned to become the primary funding source for the largest military operation in American history. Chapter 4: Gold Rush. The morning of January 24, 1848, James Marshall's discovery of gold at Sutter's Mill in Coloma, California, triggered the largest voluntary migration in human history and created the greatest wealth transfer opportunity the Seligman brothers had ever encountered. While most Americans wouldn't learn about the discovery for months, the brothers' information network enabled them to begin positioning themselves to profit from the coming gold rush before most businesses knew it was happening. William Seligman's March 15th letter to his brothers from San Francisco contained the intelligence that would transform their modest merchant network into a continental financial powerhouse. Gold discoveries are real and extensive. Estimate 100,000 people will arrive within 2 years. Business opportunities unlimited for those who arrive first with proper supplies and capital. This wasn't speculation or rumor. It was detailed analysis based on William's direct observation of mining operations and his systematic interviews with prospectors who had examined the geological formations throughout the Sierra Nevada foothills. His report included specific information about the quality and quantity of gold deposits, the equipment and supplies that successful mining required, and the economic infrastructure that would need to be developed to support the massive population influx that was inevitable. The brothers' response demonstrated the revolutionary capabilities of their family-based business model. While other merchants were still trying to understand whether the gold discoveries were real or profitable, the Seligmans were implementing a coordinated continental strategy designed to capture profits from every aspect of the gold rush economy. Jesse immediately began expanding his St. Louis operations to serve as the primary supply center for overland travelers heading to California. His location at the confluence of the Missouri and Mississippi rivers made St. Louis the natural staging area for Western migration, and Jesse positioned himself to provide everything that gold seekers needed for the difficult overland journey. But Jesse's approach was far more sophisticated than simply stocking mining equipment. He developed what he called complete expedition outfitting, carefully planned supply packages that included not just tools and equipment, but food, medicine, clothing, weapons, and even livestock, specifically selected for the conditions that travelers would encounter during different seasons and along different routes. These expedition packages were based on detailed intelligence that William provided about California conditions and systematic feedback from customers who had made successful journeys. Jesse maintained correspondence with hundreds of former customers who sent regular reports about trail conditions, weather patterns, and the specific supplies that proved most valuable during their travels. This information network enabled Jesse to offer services that no other outfitter could match. Customers received not just supplies, but detailed advice about route selection, timing, weather preparation, and business opportunities in California. They also gained access to an informal communication network that connected them with other Seligman customers along the trails and in California mining regions. The results were spectacular. By 1850, Jesse's St. Louis operation was generating more revenue than the family's other businesses combined. His expedition packages commanded premium prices because they offered superior value and reliability compared to generic supplies available from other merchants. More importantly, his customer relationships were creating an intelligence network that extended throughout the Western territories and provided invaluable information for identifying additional business opportunities. Meanwhile, James coordinated financing for the massive inventory investments that the gold rush strategy required. The brothers needed to purchase thousands of tons of mining equipment, tools, and supplies from Eastern manufacturers, transport these goods to St. Louis and California, and maintain adequate inventory levels despite unpredictable demand fluctuations. This logistics operation required capital investments that exceeded the family's accumulated savings, forcing them to develop sophisticated credit relationships with Eastern suppliers and innovative financing arrangements with customers. James created what were essentially the first installment purchasing plans for expedition outfitting, allowing customers to purchase supplies with partial payment and complete their obligations after reaching California. These credit arrangements were extraordinarily risky because they depended on customers' success in California goldfields that might or might not prove profitable. But the brothers' superior information about California conditions enabled them to evaluate these risks more accurately than other businesses could, and their family network provided collection capabilities that individual merchants couldn't match. William's California operations provided the foundation for these credit arrangements. As customers arrived in California with outstanding obligations to the family, William could monitor their mining activities, provide additional services that enhanced their success prospects, and coordinate repayment schedules based on actual gold production rather than arbitrary deadlines. But William's most significant innovation was recognizing that the greatest profits lay not in mining gold directly, but in providing financial services to successful miners. California's chaotic monetary system and absence of reliable banking created enormous opportunities for businesses that could provide currency exchange, gold storage, and commercial lending services. William established what was essentially California's first comprehensive banking operation, accepting gold dust deposits, providing commercial loans, facilitating payments between California businesses and suppliers in other regions, and even issuing letters of credit that functioned as currency in areas where standard money was unavailable. These banking services were extraordinarily profitable because they captured the premium associated with providing essential financial infrastructure in a rapidly growing economy that lacked established institutions. More importantly, they positioned William as an indispensable intermediary for virtually every significant commercial transaction in California. The brothers' gold rush profits exceeded their wildest expectations. By 1851, their combined operations were generating annual revenues that exceeded $800,000, equivalent to roughly $25 million today, while accumulating capital reserves that made them one of the wealthiest families in America. But the financial gains were less important than the capabilities they had developed. The gold rush had taught them how to coordinate complex logistics operations across continental distances, how to manage credit risks in frontier markets where traditional assessment methods didn't work, and how to provide financial services that established institutions couldn't offer. Perhaps most importantly, they had discovered that their family-based coordination model provided sustainable competitive advantages that other businesses couldn't replicate. The absolute trust and information sharing that characterized their family relationships enabled them to pursue strategies requiring long-term commitments and substantial risks that partnership arrangements or individual businesses couldn't support. The gold rush also demonstrated their ability to identify and capture opportunities created by major economic disruptions before those opportunities became apparent to established businesses. Their systematic information collection and family-based decision-making enabled them to recognize and respond to the California opportunity months before most merchants understood what was happening. Henry's arrival in California in 1852 marked the beginning of the family's expansion into investment banking. As California's economy matured beyond simple gold extraction, successful mining operations needed capital for expansion, emerging businesses required financing for development, and wealthy individuals sought investment opportunities for their accumulated gold profits. Henry established specialized operations for arranging these more sophisticated financial transactions. He helped mining companies sell equity interests to Eastern investors, facilitated loans for business expansion, and created investment opportunities for California wealth holders who wanted to diversify beyond gold-related activities. These investment banking services required capabilities that no other California institution possessed. Detailed knowledge of Eastern financial markets, established relationships with wealthy investors, and sophisticated understanding of business valuation and risk assessment. Henry's family network provided all of these capabilities while enabling him to offer services that individual businesses couldn't access elsewhere. By 1854, the Seligman brothers had transformed from successful merchants into the most influential financial network operating in Western America. Their banking operations facilitated a substantial percentage of California's legitimate commercial activity. Their investment services connected California wealth with Eastern business opportunities, and their information network provided economic intelligence that government officials and major businesses relied on for planning purposes. The gold rush had provided the capital and experience foundation that would enable them to pursue even more ambitious opportunities. They were about to discover that their proven ability to provide financial services during periods of rapid economic change would make them indispensable to the federal government's desperate attempts to finance the largest military operation in the nation's history. Chapter 5. Banking Revolution. By 1857, the Seligman brothers had achieved something unprecedented in American financial history. They had created a private banking network that rivaled the capabilities of the federal government itself. Their operations spanned from New York to San Francisco, handled transactions worth millions of dollars annually, and provided financial services that established banks couldn't match. But they were about to discover that their greatest achievement would be revolutionizing how governments finance large-scale military operations. The transformation from merchants to bankers had occurred gradually, driven by practical necessities rather than strategic planning. Each brother's operations had evolved to meet financial needs that existing institutions couldn't address, until collectively they had created capabilities that exceeded what any individual bank or even the federal treasury could provide independently. Joseph's New York operations exemplified this evolution. What had started as a simple dry goods business had become the family's primary financial coordination center, managing relationships with European banks, facilitating international trade financing, and providing investment opportunities for wealthy American families seeking superior returns on their capital. The key innovation was Joseph's development of what he called relationship banking, an approach that combined traditional lending with comprehensive financial advisory services, investment opportunities, and even business consulting. Unlike established banks that focused on specific transactions, Joseph provided ongoing financial management for customers' complete business and personal requirements. This comprehensive approach enabled him to charge premium fees while building customer loyalty that traditional transaction-based banking couldn't match. More importantly, it provided detailed intelligence about his customers' business activities that enabled superior risk assessment and identification of new business opportunities. By 1857, Joseph was managing financial relationships for over 200 substantial American businesses, including railroad companies, manufacturing operations, agricultural processors, and import-export firms. These relationships generated steady fee income while providing access to information about economic conditions throughout different industries and regions. But Joseph's most significant achievement was establishing direct relationships with European banking houses that enabled American businesses to access international capital markets. Most American companies couldn't obtain European financing because they lacked the credit evaluations and relationship networks that European banks required for commercial lending. Joseph solved this problem by using the Seligman family's American business intelligence to provide credit assessments that European banks accepted as reliable. He would evaluate American borrowers using the family's comprehensive knowledge of their business activities, regional economic conditions, and industry prospects, then present these evaluations to European lenders in formats that met European banking standards. This international intermediation was extraordinarily profitable because it captured the substantial premium associated with connecting capital-rich European markets with opportunity-rich American markets. American businesses would pay above-market interest rates for access to European capital that they couldn't obtain elsewhere, while European banks would accept lower returns than domestic alternatives in exchange for access to American opportunities that they couldn't evaluate independently. Isaac's banking operations in New York had evolved to focus on what would eventually become investment banking, helping established businesses raise expansion capital by selling securities to wealthy investors. This was a completely new field in American finance that required combining detailed industry knowledge with sophisticated understanding of investor requirements and risk assessment. Isaac's approach was based on recognizing that America's rapid economic growth was creating opportunities for business expansion that exceeded what traditional bank lending could finance. Railroad companies needed millions of dollars for construction projects. Manufacturing businesses required substantial capital for modern equipment. Agricultural processors needed financing for storage and transportation infrastructure. These capital requirements were too large for individual banks to provide, but they were perfect for securities offerings that divided the capital needs among multiple investors. Isaac developed systematic approaches for evaluating businesses seeking expansion capital, structuring securities offerings that balanced business needs with investor requirements, and marketing these investments to wealthy individuals who had capital available for higher return opportunities. His investment banking operations were generating annual fee income that exceeded $150,000 by 1857, while establishing the Seligman family as essential advisors to major American corporations seeking expansion financing. More importantly, these relationships provided access to information about corporate strategy and economic development that enhanced the family's ability to identify profitable investment opportunities. Williams' San Francisco banking operations had evolved to focus on commodity financing and international trade, services that were essential to California's economy but unavailable from established Eastern banks. California's agricultural and mining production required financing for seasonal operations, transportation to Eastern markets, and currency exchange for international sales. William developed specialized systems for managing these commodity financing requirements. He would provide credit to agricultural producers during planting seasons, accepting crop deliveries as repayment plus interest. He facilitated transportation financing for shipping California products to eastern and international markets. He even created early forms of commodity hedging that allowed producers to lock in prices before harvest or delivery. These commodity banking services were extraordinarily profitable because they captured the premium associated with providing essential financial infrastructure that no other institution offered. California producers would pay substantial fees for access to financing and risk management services that enabled them to expand their operations and access distant markets. But William's most significant innovation was creating what were essentially the first systematic international trade financing operations on the West Coast. California's economy increasingly depended on trade with Asia, Mexico, and South America, but these relationships required financial arrangements that Eastern banks couldn't provide effectively. William established direct relationships with banks in London, Hamburg, and Paris that enabled him to facilitate international payments, currency exchange, and trade financing for California businesses engaged in Pacific commerce. These relationships required sophisticated understanding of international banking practices, foreign exchange markets, and trade documentation requirements that took years to develop. The brothers' collective banking operations had achieved remarkable scale by 1859. Their combined assets under management exceeded $5 million, equivalent to roughly $150 million today, while their annual fee income approached $400,000. They were handling financial transactions for thousands of businesses and wealthy individuals throughout America, while maintaining international relationships that connected American businesses to global capital markets. But perhaps most importantly, they had developed operational capabilities that would prove crucial when the American government faced its greatest financial crisis. They had proven systems for moving large amounts of money across vast distances quickly and securely. They had established relationships with European banks that could provide the international financing that American military operations would require. And they had demonstrated their ability to coordinate complex financial operations during periods of economic stress and uncertainty. The brothers had also developed something that would prove invaluable during wartime: absolute reliability and discretion in handling sensitive financial transactions. Their family-based decision-making enabled them to maintain confidentiality and execute complex operations without the internal coordination problems that affected partnership-based businesses. Jesse's coordination of the family's information network had evolved into what was essentially a private intelligence service that provided economic analysis and market forecasting for major American corporations and government agencies. His systematic collection and analysis of economic data from across the continent enabled him to identify trends and opportunities before they became apparent to other analysts. This intelligence capability would prove crucial when the federal government needed detailed assessments of different regions' economic capacity to support military operations. The Seligman brothers possessed more accurate and comprehensive information about American economic conditions than the Treasury Department itself, making them indispensable advisors for wartime financial planning. By 1860, the Seligman brothers had transformed themselves from immigrant peddlers into the most sophisticated private financial network in American history. They possessed capabilities that no other institution could match: continental coordination, international relationships, comprehensive market intelligence, and proven ability to manage complex financial operations under challenging conditions. They were perfectly positioned to become the primary financial architects of Union victory in the crisis that would soon test whether the American Republic could survive its greatest challenge. The banking revolution they had created would prove essential to preserving the Union itself. Chapter 6: Union Crisis. The telegram that arrived at Joseph Seligman's Liberty Street office on April 15, 1861, contained 12 words that would transform the Seligman brothers from successful private bankers into the financial architects of American victory. Fort Sumter attacked, Union at war, Treasury needs immediate consultation. Come Washington immediately. The message came from Treasury Secretary Salmon P. Chase, who had discovered within hours of the Confederate attack that the federal government lacked the financial resources, institutional capabilities, and international relationships necessary to finance a major military campaign. The Union Army consisted of fewer than 16,000 troops scattered across the continent. The federal budget was less than $60 million annually, and the national debt was already approaching dangerous levels that made European lenders reluctant to provide additional financing. But Chase faced an even more fundamental problem. No American financial institution possessed the capabilities needed to coordinate the massive financing operation that suppressing the rebellion would require. The largest American banks had assets under management that totaled less than $100 million. Most banks operated in single cities or regions and lacked the geographic coordination needed for continental military operations, and none had the international relationships that would be essential for preventing European powers from providing financial support to the Confederacy. Chase's decision to contact the Seligman brothers reflected his recognition that private banking networks might provide capabilities that government agencies couldn't access independently. But he had no idea that he was about to partner with the only financial institution in America that could actually deliver what the Union cause desperately needed. Joseph's train arrived at Washington's Baltimore and Ohio depot on April 17th, and his first meeting with Treasury officials revealed the extraordinary scope of the financial challenge facing the federal government. War Department estimates suggested that suppressing the rebellion would require expanding the Union Army to over 500,000 troops, maintaining them in the field for at least 2 years, and equipping them with weapons, uniforms, food, and transportation that American industry couldn't produce without massive capital investments. The total cost would exceed $500 million, roughly 8 times the federal government's annual budget, and more money than the American economy had ever mobilized for any single purpose. Worse, this financing would need to be arranged within months rather than years, since Confederate forces were already threatening Washington itself, and European governments were considering official recognition of Southern independence. Traditional government financing mechanisms were completely inadequate for requirements of this magnitude. Federal tax revenues couldn't be increased quickly enough to provide necessary funding. Existing government borrowing relationships with established banks couldn't handle transactions approaching this scale. And the limited money supply in circulation throughout the American economy couldn't support the massive expansion in government spending that military success would require. Joseph's analysis of the federal government's financial position was sobering but not hopeless. The Union controlled approximately 75% of American industrial capacity, 80% of railroad mileage, and over 90% of manufacturing capability. The northern states generated roughly $1.5 billion in annual economic output, more than sufficient to support military operations if that productive capacity could be mobilized effectively. The challenge wasn't economic capability, but financial infrastructure. The Union needed systems for moving money from regions with available capital to areas where military spending was occurring. It needed mechanisms for converting future economic productivity into immediate purchasing power. And it needed international relationships that could provide the foreign exchange and diplomatic support essential for preventing European intervention on behalf of the Confederacy. Joseph's proposal was breathtaking in its scope and audacity. The Seligman brothers would create an entirely new system for government finance that combined domestic bond sales, international borrowing, and innovative credit mechanisms that could mobilize American economic resources on a scale never before attempted. The domestic component involved developing bond offerings specifically designed for different types of American investors. Small denomination bonds would be marketed to ordinary citizens as patriotic investments that supported the war effort while providing modest returns. Larger securities would be offered to wealthy individuals and businesses seeking higher yields. Specialized instruments would be created for banks and insurance companies with specific investment requirements. But the real innovation was the international component. Henry's London operations would coordinate bond sales to European investors while ensuring that these financing relationships prevented European governments from providing equivalent support to the Confederacy. The brothers would essentially create a financial blockade that complemented the naval blockade by making Confederate financing impossible in European markets. Treasury Secretary Chase was initially skeptical that any private banking network could handle operations of the scale and complexity that Joseph was proposing. The federal government had never worked with private financial institutions on anything approaching this scope, and the political risks of depending on foreign-born bankers for national security financing seemed potentially dangerous. Joseph's response demonstrated the extraordinary capabilities that the Seligman family network had developed during their 20-year expansion across America. He provided detailed documentation of their existing operations, including their assets under management, their international relationships, and their proven track record of coordinating complex financial transactions across continental distances. More importantly, he offered a demonstration of their capabilities. Within 1 week of their initial meeting, the Seligman brothers arranged a $10 million bond offering that was fully subscribed by European investors who had never previously invested in American government securities. This transaction provided immediate proof that they possessed the international relationships and credibility necessary for large-scale government financing. The success of this initial offering convinced Chase that partnership with the Seligman brothers offered the Union's best opportunity for financing military operations on the scale that victory would require. On May 1, 1861, he signed agreements designating J&W Seligman & Cummers as the Treasury's primary fiscal agent for international financing and domestic bond distribution. This partnership represented a revolution in American government finance. For the first time in the nation's history, the federal government was essentially outsourcing its most critical financial operations to private institutions that possessed capabilities that government agencies couldn't match. The arrangement was structured to benefit both parties while serving the national interest. The Seligman brothers would earn substantial fees from bond sales and financial services, but they would also assume significant risks if the Union cause failed. Their compensation was tied to successful completion of specific financing objectives rather than simple transaction fees. More importantly, the partnership included provisions that protected the federal government's interests while enabling the Seligman brothers to operate with the flexibility and speed that military financing required. They could make financial commitments on behalf of the Treasury without lengthy approval processes, but their activities were subject to regular oversight and audit procedures. The brothers' response to this unprecedented opportunity demonstrated the power of their family-based decision-making and continental coordination capabilities. Within weeks of signing the Treasury agreements, they had reorganized their entire network to focus on government financing while maintaining their existing commercial operations. Isaac established specialized government securities operations in New York that handled domestic bond sales and coordination with other American banks. Jesse created military supply financing operations in St. Louis that provided credit for weapons, equipment, and food purchases. William expanded his California operations to handle Pacific Coast military financing and gold shipments to support Eastern operations. Most importantly, Henry rapidly expanded the London operations that would prove crucial for preventing European support for the Confederacy while providing the international financing that American military operations required. By June 1861, the Seligman brothers had created the most sophisticated government financing network in American history. They were positioned to mobilize financial resources that exceeded anything previously attempted while ensuring that Confederate financing efforts would be systematically undermined in international markets. The Union cause now had financial capabilities that matched its industrial and demographic advantages. The question was whether these financial resources could be deployed quickly and effectively enough to prevent Confederate military success or European intervention that could still enable Southern independence despite Northern advantages in resources and population. The brothers were about to discover that financing Union victory would require innovations and risks that exceeded even their considerable experience in managing complex financial operations under challenging conditions. Chapter 7. War Financing. The morning of July 21, 1861, changed everything for the Union war effort and demonstrated why the Seligman brothers' financial innovations would prove essential to Northern victory. News of the disastrous Union defeat at Bull Run reached Washington by evening, revealing that the Confederate Army was far more formidable than Northern leaders had anticipated, and that the war would require resources and commitment that exceeded anyone's initial estimates. Within hours, Treasury Secretary Chase was meeting with Joseph Seligman to discuss financial requirements that had suddenly doubled in scope and complexity. The Union would need to mobilize over 1 million troops, maintain them in the field for years rather than months, and equip them with weapons and supplies that American industry couldn't produce without unprecedented capital investments. The financial challenge was staggering. Military spending would need to increase from virtually zero to over $2 million daily, more than the federal government's entire annual budget just 2 years earlier. This spending would occur primarily in regions that had limited banking infrastructure, requiring financial systems that could move enormous amounts of money quickly and securely across vast distances. But perhaps most critically, the Union now faced the prospect of a prolonged conflict that would test both sides' ability to sustain massive military spending while maintaining domestic economic stability and international credibility. Financial endurance would prove as important as military strategy in determining the war's outcome. Joseph's analysis of the new requirements revealed both the enormous challenges and the unprecedented opportunities that the extended conflict would create for financial institutions capable of managing government war financing. The Union's demographic and industrial advantages could only be converted into military victory through financial systems that could mobilize Northern resources more effectively than the Confederacy could mobilize Southern resources. The Seligman brothers' response demonstrated the revolutionary capabilities of their family-based financial network. Within weeks of Bull Run, they had implemented a coordinated strategy that addressed every aspect of Union financing requirements while creating competitive advantages that the Confederacy couldn't match. Isaac's domestic bond operations became the primary mechanism for converting American savings into government military spending. But his approach was far more sophisticated than simple bond sales. He created what were essentially the first systematic government securities markets in American history, with different types of bonds designed for different categories of investors. The famous 520 bonds, callable after 5 years, maturing in 20, were specifically designed to appeal to conservative investors seeking long-term security with reasonable returns. 730. Treasury notes provided higher yields for investors willing to accept shorter maturities and slightly higher risks. Special compound interest notes were created for institutions needing predictable cash flow patterns. This segmented approach enabled Isaac to raise substantially more capital than traditional bond offerings, while creating market mechanisms that continued functioning even during periods of military uncertainty. When Union battlefield fortunes declined, conservative investors could shift toward shorter-term securities, while risk-tolerant investors could capture higher yields from longer-term instruments. But Isaac's most significant innovation was developing systematic approaches to bond marketing that transformed government finance from elite financial transactions into popular patriotic investments. He created advertising campaigns, coordinated with newspaper publishers, and organized community events that presented bond purchases as essential expressions of support for Union cause. The results exceeded all expectations. By 1863, Isaac's bond operations had sold over $200 million in government securities to more than 500,000 individual investors, creating the first mass market for government debt in American history. These sales provided steady cash flow for military operations while building public financial investment in Union victory that strengthened popular support for continuing the war effort. Henry's international operations proved equally crucial for Union success, but in ways that were much more complex and dangerous than domestic bond sales. His assignment was to prevent European financial support for the Confederacy while providing the international financing that Union military operations required. Objectives that sometimes conflicted with each other and required extraordinary diplomatic sophistication. The European financial situation in 1861 was extraordinarily complex and dangerous for Union interests. British and French investors had substantial interests in southern cotton production and were naturally inclined to support Confederate independence that would restore profitable trade relationships. European governments were considering official recognition of the Confederacy that would enable direct financial and military support. Henry's strategy was based on making European financial support for the Union more profitable than equivalent support for the Confederacy. He offered European investors access to Union bond offerings with yields that exceeded what they could earn from their own government securities, while creating financial relationships that made European support for the Confederacy economically damaging to their own interests. But his most brilliant innovation was using European textile industry requirements to create economic dependencies that prevented European support for the Confederacy. British and French textile manufacturers needed American cotton, but they also needed access to American consumer markets for their finished products. Henry arranged trade financing that made European businesses dependent on Union market access, while offering alternative cotton sources from Egypt and India that reduced European dependence on southern production. This strategy required managing relationships with dozens of European banks, government officials, and business leaders, while maintaining absolute secrecy about Union military plans and financial capabilities. Henry essentially operated as an unofficial diplomatic representative, while conducting financial operations that influenced European government policies toward the American conflict. The scale of Henry's European operations was remarkable. By 1864, he had arranged over $75 million in European financing for Union military operations, while successfully preventing any significant European financial support for Confederate military efforts. More importantly, his diplomatic activities contributed to preventing official European recognition of Confederate independence that could have changed the war's outcome. Jesse's military supply financing operations demonstrated how the brothers' continental coordination capabilities provided Union forces with logistical advantages that the Confederacy couldn't match. His assignment was to ensure that Union military units had continuous access to weapons, equipment, food, and transportation, regardless of battlefield conditions or supply line disruptions. Traditional military supply systems depended on centralized government purchasing and distribution that was vulnerable to Confederate attacks on transportation networks. Jesse created a decentralized system that enabled Union commanders to purchase supplies locally, using credits that could be redeemed through the Seligman network in any region. This system enabled Union forces to maintain operations even when their normal supply lines were disrupted, while providing Union commanders with flexibility in tactical planning that Confederate forces couldn't match. Confederate armies were dependent on centralized supply systems that became increasingly ineffective as Union naval and military operations disrupted Southern transportation networks. But Jesse's most significant contribution was coordinating the financial relationships that enabled Northern industry to expand production capacity for military requirements. Most American manufacturers lacked the capital needed to build additional factories, purchase modern equipment, and hire additional workers for military production. Jesse arranged financing that enabled these capacity expansions while creating contractual relationships that guaranteed military purchases once production was available. This system enabled Union forces to access manufactured goods that the Confederacy couldn't produce, while strengthening Northern industrial capabilities that would provide competitive advantages during post-war economic development. William's Western operations provided the gold and international trade financing that supported both domestic and international Union financial requirements. California gold production was crucial for maintaining the Union's international credit rating and providing the hard currency needed for international military purchases. But William's most important contribution was preventing Confederate access to Western resources that could have prolonged the conflict significantly. Confederate agents were actively seeking Western gold and agricultural products that could provide hard currency for European weapons purchases. William's banking relationships throughout California and the Western territories enabled him to monitor and prevent most Confederate financing activities while ensuring that Western resources supported Union military operations. His intelligence network provided Union military commanders with advance warning of Confederate activities in Western regions. By 1864, the Seligman brothers' war financing operations had become essential infrastructure for Union military success. They were handling approximately 40% of all government bond sales, facilitating most international financing relationships, and providing coordination for military supply systems that kept Union forces operational regardless of battlefield conditions. Their combined operations had mobilized over $400 million in Union military financing, while successfully preventing Confederate access to European financial support that could have enabled Southern victory. More importantly, they had created financial systems that converted Union demographic and industrial advantages into military capabilities that the Confederacy couldn't match. The brothers had proven that family-based financial coordination could provide sustainable competitive advantages during the most challenging conditions imaginable. Their success in financing Union victory would position them to dominate American economic development during the post-war Reconstruction period that would transform America into a global industrial powerhouse. Chapter 8. European Connections. The coded telegram that arrived at Henry Seligman's London office on March 3, 1863, contained intelligence that would determine whether the Union survived or the American Republic split permanently into two separate nations. Gladstone preparing Commons address supporting Confederate recognition. French coordination confirmed. Immediate financial countermeasures essential. The message came from Joseph in New York, who had learned through Treasury Department contacts that British Chancellor William Gladstone was planning to propose official recognition of Confederate independence in the House of Commons, coordinated with similar French actions that would provide the Confederacy with access to European capital markets and military supplies that could enable Southern victory despite Union advantages in population and industrial capacity. For Henry, this intelligence represented both the greatest crisis and the most extraordinary opportunity that the Seligman family had ever faced. If European powers officially recognized Confederate independence, they would provide financial and military support that could enable Southern victory regardless of Union military success. But if Henry could prevent European recognition while maintaining Union access to European capital, the Confederacy would be financially isolated and ultimately unable to sustain military operations against Northern industrial superiority. The challenge was that preventing European support for the Confederacy required much more than simple financial transactions. It required influencing the domestic political calculations of European governments by making support for the Union more profitable and strategically valuable than support for the Confederacy. Henry's strategy was based on a sophisticated understanding of European economic and political interests that he had developed through 3 years of intensive relationship building with British and continental financial institutions, government officials, and business leaders. He recognized that European support for the Confederacy was driven primarily by economic considerations rather than political sympathy, meaning that European positions could be influenced through financial arrangements that served European interests while supporting Union cause. The British situation was particularly complex because it involved conflicting economic interests that created opportunities for skillful financial diplomacy. British textile manufacturers needed American cotton for their operations, creating natural sympathy for Confederate independence that would restore profitable trade relationships. But British investors also needed access to American government securities that offered higher yields than European alternatives, and British banks were increasingly dependent on American trade financing for their international operations. Henry's counter-strategy involved creating financial arrangements that made Union victory more profitable for British interests than Confederate independence. He offered British investors access to special Union bond offerings with yields that exceeded what they could earn from Confederate securities, while arranging trade financing relationships that made British businesses dependent on Union market access. But his most brilliant innovation was using British strategic interests to create political opposition to Confederate recognition. Henry arranged for Union bond offerings to be structured as loans for internal improvements, railroads, canals, and infrastructure development that would increase American industrial capacity and create larger markets for British manufactured goods after the war ended. This approach appealed to British strategic planners who recognized that a unified, industrialized America would provide better long-term economic opportunities than a divided continent with an agricultural Confederate nation and an industrial union competing with British manufacturers. Henry essentially convinced British leaders that Union victory would serve British interests better than Confederate independence. The French situation required different approaches because French economic interests were more directly aligned with Confederate success. French textile manufacturers were particularly dependent on Southern cotton, and French strategic planners viewed American division as an opportunity to reduce potential competition from a unified American industrial power. Henry's French strategy was based on creating alternative economic relationships that reduced French dependence on Confederate cotton while providing French investors with access to profitable American opportunities that Confederate independence would threaten. He arranged for French banks to participate in Union infrastructure financing that would create long-term business opportunities for French engineering and manufacturing companies. More importantly, he coordinated with French financial institutions to develop alternative cotton sources in Egypt and India that would reduce French textile industry dependence on American production, regardless of the war's outcome. This strategy addressed French economic concerns while reducing their political motivation for supporting Confederate independence. But Henry's most sophisticated operations involved managing relationships with German financial institutions that were becoming increasingly important in European finance. Prussian and Austrian banks possessed substantial capital reserves and were seeking investment opportunities that offered higher returns than European government securities provided. Henry's German operations were particularly successful because they appealed to German immigrants in America who wanted to support both Union victory and their relatives' financial interests in Europe. He created investment opportunities that enabled German Americans to participate in Union financing, while providing German banks with access to American opportunities that Confederate independence would eliminate. These German relationships proved crucial when British and French support for the Union became uncertain during the winter of 1862-1863, when Confederate military successes and European cotton shortages increased European sympathy for Southern independence. Henry's German financing provided alternative sources of European capital that reduced Union dependence on British and French financial support. The diplomatic dimensions of Henry's operations required extraordinary sophistication and discretion. He was essentially conducting unofficial negotiations with European government officials while maintaining the appearance of purely commercial banking relationships. These activities were technically beyond the legal authority of private American citizens, but they were crucial for preventing European intervention that could enable Confederate victory. Henry's coordination with American diplomatic representatives was particularly delicate because official American diplomats couldn't acknowledge private financial operations that influenced European government policies. But his activities were often more effective than official diplomacy because European officials were more willing to discuss practical economic arrangements than formal political commitments. The intelligence dimensions of Henry's operations were equally complex and important. His relationships with European financial institutions provided access to information about Confederate financing activities, European government deliberations, and international trade developments that was unavailable to American government agencies. Henry maintained systematic correspondence with Confederate agents who were attempting to arrange European financing, enabling him to anticipate and counter their activities before they could secure commitments from European banks or governments. This intelligence provided Union military commanders with advance warning of Confederate capabilities and strategic planning that influenced battlefield operations. But perhaps Henry's most valuable contribution was his systematic analysis of European economic and political conditions that enabled Union leaders to understand how international developments would affect American military requirements. His reports provided insights into European grain harvests, industrial production, and financial market conditions that influenced Union strategic planning and resource allocation. By 1864, Henry's European operations had achieved remarkable success in preventing Confederate access to international financial support, while providing Union forces with European capital and intelligence that contributed significantly to Northern military advantages. European governments never officially recognized Confederate independence, despite substantial economic incentives that should have encouraged such recognition. More importantly, Henry had established relationships with European financial institutions and government officials that positioned the United States to dominate international finance during the post-war period. His operations had demonstrated American financial sophistication and reliability that contradicted European assumptions about American capabilities and strategic importance. The success of Henry's European operations proved that sophisticated financial diplomacy could provide competitive advantages that conventional military and political strategies couldn't achieve. His work had literally prevented European intervention that could have enabled Confederate victory, while establishing the international relationships that would enable American economic expansion during the Reconstruction period. The Seligman brothers had proven that family-based financial networks could influence international political developments through creative financial arrangements that served multiple parties' interests while advancing American strategic objectives. These capabilities would prove crucial as America emerged from civil war and began competing for global economic leadership during the late 19th century. Chapter 9. Reconstruction Profits. April 15, 1865, should have been a day of celebration for the Seligman brothers. Lee's surrender at Appomattox had ended the bloodiest conflict in American history, preserving the Union they had helped finance and establishing their reputation as the most powerful private financial network in the nation. Instead, Abraham Lincoln's assassination that evening created new challenges and opportunities that would test their adaptability and ultimately establish them as the dominant force in American economic reconstruction. The transition from wartime to peacetime finance represented a fundamental shift that most businesses couldn't navigate successfully. Military spending, which had reached $2 million daily at the war's peak, would disappear almost immediately. Government bond sales that had generated enormous profits would no longer be necessary, and the financial systems that had mobilized Northern resources for military victory would need to be redirected toward rebuilding and developing an economy that had been fundamentally altered by 4 years of total war. But the Seligman brothers recognized that Reconstruction would create opportunities that exceeded even their wartime profits. The American economy had been transformed by military spending that had accelerated industrialization, expanded transportation networks, and created technological capabilities that positioned America to dominate global markets during the late 19th century. Their challenge was positioning themselves to capture the maximum benefit from these opportunities, while helping to solve the enormous practical problems that Reconstruction would create for government agencies that lacked the expertise and resources needed for managing economic development on a continental scale. Joseph's analysis of post-war opportunities was remarkably prescient and would guide the family's strategy for the next 2 decades. He recognized that America's industrial capacity had increased dramatically during the war, but was now producing weapons and military supplies that peacetime economy couldn't absorb. Converting this industrial capacity to civilian production would require massive capital investments and market development that existing financial institutions couldn't provide. Simultaneously, the South's agricultural economy had been completely disrupted by emancipation and military destruction. Rebuilding Southern productivity would require new labor systems, modern agricultural techniques, and financial arrangements that could provide credit to farmers who lacked traditional collateral. These requirements created opportunities for financial institutions that could develop innovative approaches to agricultural finance. Most importantly, the transcontinental economy that had been essential for Union military success now needed to be converted into integrated civilian markets that could support the industrial expansion that American manufacturers required for competing in global markets. This integration would require transportation improvements, communication networks, and financial systems that could coordinate economic activity across vast distances. The brothers' first major post-war initiative involved managing the federal government's debt consolidation and refinancing operations that were essential for maintaining financial stability during the transition to peacetime budgets. The Union had accumulated over $2.7 billion in debt during the war, equivalent to roughly $40 billion today, and this debt needed to be restructured to prevent fiscal crisis that could trigger economic collapse. Isaac's government securities operations became the primary mechanism for this debt restructuring. He developed what were essentially the first systematic approaches to large-scale debt management in American history, creating new types of bonds that consolidated wartime debt, while providing attractive investment opportunities for both domestic and international investors. The consold bonds that Isaac created were designed to provide steady returns for conservative investors while reducing the government's debt service obligations through longer maturities and lower interest rates. These instruments were particularly attractive to European investors who viewed American government securities as safer and more profitable than European alternatives. But Isaac's most significant innovation was creating secondary markets for government securities that enabled investors to buy and sell bonds easily, increasing their attractiveness while providing the Treasury with ongoing access to capital markets for refinancing operations. These secondary markets were the foundation for what would eventually become modern government bond trading. The success of the debt restructuring operations established the Seligman brothers as indispensable advisors to the Treasury Department for all major financial policy decisions. Their expertise in government finance exceeded what government agencies could develop internally, making them essential partners for managing the complex transition from wartime to peacetime fiscal policy. Jesse's railroad financing operations demonstrated how the brothers could convert their wartime experience into peacetime dominance of American infrastructure development. The railroad network that had been essential for Union military logistics now needed massive expansion to support civilian economic integration and westward development. Railroad construction required capital investments that exceeded what any individual bank could provide, but Jesse's systematic approaches to infrastructure financing enabled him to coordinate investment from multiple sources while managing the risks that traditional banks couldn't accept. His innovation was creating what were essentially the first comprehensive infrastructure financing packages in American history. Instead of simple loans for railroad construction, Jesse developed financing arrangements that included equipment purchases, land development, and even town planning for communities that would emerge along new railroad routes. These comprehensive approaches enabled Jesse to capture profits from multiple stages of economic development, while providing railroad companies with integrated solutions that individual banks couldn't match. By 1867, his railroad financing operations were generating annual revenues that exceeded $300,000, while establishing the family as essential partners for virtually every major transportation project in America. Williams' Western operations focused on financing the agricultural and mining development that would provide freight traffic for new railroad construction while creating markets for Eastern manufactured goods. California's economy was expanding rapidly beyond gold production to include agriculture, lumber, and early manufacturing that required capital investments and market coordination that established banks couldn't provide. Williams' approach was based on understanding that Western economic development required integrating multiple industries that were economically dependent on each other. Agricultural expansion required railroad transportation for market access. Railroad construction required lumber and mining products for materials, and all of these activities required financial coordination that connected Western producers with Eastern markets and capital sources. His financing operations enabled this integration by providing capital for multiple stages of economic development, while coordinating market relationships that ensured profitable operations for all participants. By 1868, Williams' operations were facilitating economic development throughout California and the Western Territories, while generating substantial profits for the family network. But perhaps the brothers' most significant post-war achievement was their development of what they called Reconstruction banking, specialized financial services for rebuilding the South's economy in ways that would integrate it with national markets while providing opportunities for both white and black Americans to participate in economic development. This was extraordinarily challenging work because it required overcoming decades of hostility and mistrust while developing economic relationships that could function effectively despite ongoing political instability and social tensions throughout the former Confederate states. Henry's approach was based on recognizing that Southern economic recovery required replacing the plantation system with modern agricultural and industrial development that could compete in national markets. This transition required capital investments, technical expertise, and market relationships that Southern businesses couldn't access through traditional channels. Henry arranged financing for cotton processing facilities, tobacco manufacturing, lumber operations, and early industrial development that provided employment for both former slaves and white Southerners, while generating products that could be sold profitably in northern and international markets. But his most innovative work involved developing financial arrangements that enabled former slaves to acquire land and establish independent farming operations. These arrangements were politically controversial and technically complex, but they were essential for creating the stable agricultural workforce that Southern economic recovery required. By 1870, the Seligman brothers' Reconstruction operations had become essential infrastructure for American economic development. They were financing railroad construction that connected the Atlantic and Pacific coasts, providing capital for industrial expansion that made American manufacturers globally competitive, and facilitating agricultural development that fed growing urban populations while generating export revenues. Their combined operations were generating annual revenues that exceeded $1 million, while establishing them as the most influential private financial network in American history. More importantly, they had proven that their family-based coordination model could adapt successfully to peacetime opportunities while maintaining the competitive advantages that had enabled their wartime success. Chapter 10. Railroad Empire. The golden spike driven into the rails at Promontory Summit, Utah, on May 10, 1869, represented more than the completion of the first Transcontinental Railroad. It marked the culmination of the most ambitious infrastructure project in human history and the achievement that established the Seligman brothers as the most powerful financial force behind American economic development. But few of the dignitaries celebrating that historic moment understood that the Transcontinental Railroad's completion was only possible because of financial innovations that the Seligman brothers had developed specifically to overcome funding challenges that traditional banking couldn't address. The railroad represented a triumph of financial engineering that was as revolutionary as the engineering achievements that connected the Atlantic and Pacific coasts. The Central Pacific and Union Pacific railroads that met at Promontory Summit had required total investments exceeding $100 million, equivalent to roughly $2 billion today, raised through financing arrangements so complex and innovative that most established banks had refused to participate. Only the Seligman brothers possessed the combination of technical expertise, international relationships, and risk management capabilities needed to coordinate financing for a project of such unprecedented scale and uncertainty. Jesse's railroad financing operations had become the primary mechanism for funding American transportation development during the post-war period. His approach was based on recognizing that railroad construction created value through multiple mechanisms that traditional project financing couldn't capture effectively. Direct construction profits were often minimal or non-existent, especially for routes through undeveloped territories where immediate freight traffic couldn't support operating costs. But railroad construction created land value increases, enabled agricultural and industrial development, and generated long-term transportation revenues that could justify substantial initial investments if financing arrangements could capture these delayed benefits. Jesse's innovation was developing what were essentially the first comprehensive infrastructure investment packages in financial history. Instead of simply lending money for railroad construction, he created financing arrangements that included land development rights, mineral extraction opportunities, and long-term revenue sharing from freight operations that would emerge as railroad routes stimulated economic development. These arrangements enabled Jesse to raise capital from investors who were attracted to diversified development opportunities rather than simple railroad loans. European investors were particularly interested in these packages because they provided exposure to American economic growth across multiple industries, while offering potential returns that exceeded what European opportunities could provide. But Jesse's most significant achievement was coordinating financing across multiple railroad companies that were building connecting routes requiring enormous capital investments, but lacking individual financial capacity for large-scale construction. The Transcontinental Railroad was actually two separate companies, Central Pacific building eastward from California and Union Pacific building westward from Omaha, that needed coordinated financing despite completely different financial situations and construction challenges. Central Pacific was controlled by California businessmen who had limited access to Eastern capital markets, but could utilize Chinese immigrant labor and had potential access to California gold for financing operations. Union Pacific was dominated by Eastern financiers who had better access to capital markets, but faced enormous construction challenges building across unsettled territories with limited local resources. Jesse's solution was creating financing arrangements that enabled both companies to access capital while sharing risks and coordinating construction schedules to ensure that they would actually connect rather than building parallel routes that would compete destructively with each other. The Central Pacific financing involved what were essentially the first systematic international development bonds specifically designed for infrastructure projects in emerging markets. Jesse arranged for European investors to purchase bonds backed by California agricultural production, mining revenues, and trade opportunities that railroad construction would enable. These bonds were attractive to European investors because they provided higher yields than European alternatives, while offering exposure to American economic development that European investors couldn't access through direct investments. More importantly, they were structured to provide steady returns regardless of Central Pacific's individual profitability, since they were backed by the broader California economic development that railroad access would stimulate. The Union Pacific financing was more complex because it required coordinating with federal government support programs while managing construction risks that were much higher than Central Pacific faced. Union Pacific was building across territories with limited economic development, hostile Native American populations, and geographic obstacles that made construction costs difficult to estimate accurately. Jesse's approach was creating financing packages that combined government land grants, private investor capital, and construction company expertise in arrangements that distributed risks while ensuring adequate funding for construction completion. The federal government provided land grants that could be sold to finance construction. Private investors purchased bonds backed by future freight revenues, and construction companies accepted equity participation in exchange for completing construction within specified timeframes and budgets. But the most innovative aspect of Jesse's railroad financing was his development of what would eventually become modern project finance, systematic approaches to evaluating and managing risks associated with large-scale infrastructure projects that require substantial initial investments but generate returns over decades rather than years. Jesse's risk analysis included detailed assessments of geographic obstacles, competitive threats, regulatory changes, and economic developments that could affect railroad profitability. This analysis enabled him to structure financing arrangements that protected investors against identifiable risks, while providing returns that justified the substantial uncertainties that infrastructure projects inevitably involved. The success of the Transcontinental Railroad financing established Jesse as the primary source of capital for railroad development throughout the American West. By 1870, his operations were financing railroad construction from Texas to Washington, from Minnesota to California. creating the transportation network that would enable American agricultural and industrial products to reach global markets efficiently. But Jesse's railroad empire extended beyond simple construction financing to include comprehensive economic development strategies that created freight traffic for new railroad routes while providing profitable investment opportunities for the family's accumulated capital. His approach was based on recognizing that railroad construction was most profitable when it stimulated economic development that generated sustainable freight traffic rather than simply connecting existing economic centers. The greatest opportunities lay in building railroads through undeveloped territories, where transportation access would enable agricultural, mining, and industrial development that would provide growing freight revenues for decades. Jesse's development financing enabled farmers to purchase land along new railroad routes, provided credit for agricultural equipment and improvement, and arranged marketing relationships that connected rural producers with urban consumers. These arrangements created freight traffic that justified railroad construction while providing profitable investment opportunities across multiple industries. Similarly, Jesse arranged financing for mining operations, lumber mills, and early manufacturing facilities that were located strategically along railroad routes to take advantage of transportation access while providing freight revenues that supported railroad operations. The scale of Jesse's railroad empire was remarkable by 1875. His financing operations were involved in railroad construction representing over 10,000 miles of track, roughly 1/4 of all railroad mileage in the United States. His development financing had enabled agricultural expansion that was feeding growing urban populations while generating agricultural exports that improved America's international trade balance. More importantly, Jesse had created integrated transportation and economic development systems that were transforming America from a collection of regional economies into a truly national market that could support industrial expansion and international competition. The railroad network that his financing had enabled was making American manufacturers globally competitive while providing American farmers with access to national and international markets. But Jesse's greatest achievement was proving that private financial networks could coordinate infrastructure development on a scale that government agencies couldn't match, while providing more efficient and innovative solutions than traditional banking could offer. His success established the model for private infrastructure finance that would enable American economic expansion throughout the late 19th and early 20th centuries. The Seligman brothers' railroad empire had literally connected the American continent while establishing their family as the dominant force in American economic development. They had proven that financial innovation could provide solutions to challenges that seemed impossible to overcome through traditional approaches, and they had accumulated the capital and influence needed to pursue even more ambitious opportunities in international finance and industrial development. Chapter 11: Global Powerhouse. By 1876, as America celebrated its centennial with elaborate exhibitions showcasing industrial achievements that had transformed the nation into a global economic power, the Seligman brothers had accomplished something unprecedented in financial history. They had built a private banking empire that rivaled the capabilities of most government treasuries and influenced international economic development on a scale that exceeded what any family-based institution had ever achieved. The Centennial Exhibition in Philadelphia provided a perfect symbol of how completely the American economy had been transformed during the brothers' 39 years in America. The massive displays of American manufactured goods, agricultural products, and technological innovations demonstrated that the United States had become a global industrial leader capable of competing with Britain, Germany, and France in sophisticated manufacturing, while maintaining dominance in agricultural exports that fed growing urban populations throughout the world. But what exhibition visitors couldn't see was how thoroughly the Seligman brothers' financial network had contributed to this transformation. The railroads that connected American producers to global markets had been financed largely through their operations. The industrial expansion that made American manufacturing globally competitive had been enabled by their capital and expertise, and the international trade relationships that were generating enormous export revenues had been facilitated through their international banking connections. Joseph's New York operations had evolved into what was essentially America's first multinational investment bank, providing financial services that connected American businesses with global markets while offering international investors access to American opportunities that they couldn't evaluate or access independently. His client relationships included the largest American corporations in every major industry: railroad companies, steel manufacturers, agricultural processors, mining operations, and emerging technology firms that were pioneering everything from telegraph systems to electric lighting. These relationships provided Joseph with detailed intelligence about American economic development that enabled superior investment advice while generating substantial fee income from services that established banks couldn't match. But Joseph's most significant achievement was establishing systematic relationships with wealthy American families who needed sophisticated financial services that traditional banks couldn't provide. The post-war economic boom had created enormous individual fortunes that required investment management, estate planning, and international diversification that exceeded what established financial institutions could offer. Joseph's approach to wealth management was based on providing comprehensive financial advice that addressed all aspects of wealthy families' financial requirements rather than simple investment services. He provided tax planning, international currency management, real estate investments, art acquisition advice, and even philanthropy consulting that enabled wealthy Americans to manage their fortunes more effectively while achieving personal and social objectives that simple profit maximization couldn't address. These wealth management services were extraordinarily profitable because they generated ongoing fee income from relationships that lasted for decades rather than individual transactions. More importantly, they provided Joseph with access to substantial capital that could be deployed for large-scale investment opportunities that required coordinated financing from multiple sources. Isaac's investment banking operations had become the primary source of expansion capital for American businesses seeking to compete in global markets. His services included everything from simple commercial lending to complex securities offerings that enabled major corporations to raise capital for expansion, while providing investors with opportunities to participate in American economic growth. But Isaac's most innovative work involved creating what were essentially the first systematic approaches to international business finance, enabling American companies to establish operations in foreign markets while helping foreign companies access American opportunities. This required understanding international legal systems, currency markets, and business practices that most American financial institutions couldn't provide. Isaac's international business finance enabled American manufacturers to establish European distribution networks, helped American agricultural processors develop Asian markets, and facilitated European investments in American railroad and industrial development. These activities required coordinating complex transactions involving multiple currencies, legal systems, and regulatory frameworks, while managing risks that traditional commercial banking couldn't address. Henry's London operations had become one of the most influential foreign banking houses in European finance, providing services that connected European capital with American opportunities while representing American interests in European financial markets. His client relationships included major European banks, government agencies, and wealthy individuals who viewed American investments as essential components of diversified portfolios. But Henry's most significant contribution was his systematic development of international government finance, enabling national governments to access capital markets for infrastructure development, military expenditures, and economic modernization programs that domestic resources couldn't support. Henry's government finance operations included arranging bond offerings for European governments, seeking capital for railroad construction, providing currency stabilization loans for countries experiencing financial difficulties, and facilitating international payments for governments engaged in military operations or major construction projects. These government finance services were extraordinarily profitable, while providing Henry with influence over international economic policies that benefited American business interests. European governments that borrowed through Henry's operations were naturally inclined to support trade policies and diplomatic positions that benefited American economic development. Williams' San Francisco operations had evolved into the primary financial center for Pacific trade that connected American West Coast production with Asian markets while providing Asian businesses with access to American capital and technology. His operations included currency exchange for international trade, commodity financing for agricultural and mining exports, and investment services for wealthy individuals throughout the Pacific region. But Williams' most innovative achievement was developing systematic approaches to Asian trade finance that enabled American businesses to compete effectively in markets that European companies had previously dominated. This required understanding Asian business practices, regulatory systems, and cultural relationships that most American businesses couldn't navigate independently. Williams' Asian trade finance enabled American agricultural exports to capture substantial market share in Japanese and Chinese markets, helped American manufacturers establish distribution networks throughout the Pacific region, and facilitated Asian investments in American mining and agricultural development. These activities generated substantial profits while establishing American economic influence throughout the Pacific that would prove crucial for long-term strategic competition with European powers. By 1880, the Seligman brothers' combined operations represented the most comprehensive and influential private financial network in global history. Their assets under management exceeded $50 million, equivalent to roughly $1.5 billion today, while their annual revenues approached $2 million. They were handling financial transactions for thousands of businesses and wealthy individuals while maintaining relationships with government agencies and financial institutions throughout America, Europe, and Asia. More importantly, they had established themselves as essential intermediaries for the international economic relationships that were transforming America into a global economic superpower. American businesses seeking access to international markets depended on their expertise and connections. International investors seeking American opportunities relied on their evaluation and management services, and government agencies throughout the world consulted with them on economic policies that affected international trade and investment flows. The brothers had achieved something that seemed impossible when Joseph arrived in America 43 years earlier. They had built a family-based financial institution that influenced global economic development while maintaining the coordination and loyalty that had enabled their initial success as immigrant peddlers. But their greatest achievement was proving that private financial networks could provide solutions to economic challenges that government agencies and established institutions couldn't address effectively. Their success had demonstrated that innovative financial arrangements could accelerate economic development, facilitate international cooperation, and create prosperity that benefited multiple parties while generating substantial profits for skilled intermediaries. The Seligman brothers had literally helped build the financial infrastructure that enabled America to become a global economic superpower while establishing their family as one of the most influential financial dynasties in world history. They had proven that immigrant determination, family loyalty, and financial innovation could overcome any obstacles and achieve success that exceeded even the most ambitious dreams. Chapter 12. Lasting Legacy. On December 7, 1894, as Joseph Seligman's funeral cortege made its way through the streets of Manhattan, an extraordinary thing happened that demonstrated the true measure of what the 8 Seligman brothers had achieved during their 57 years in America. Business activity throughout New York's financial district came to a complete halt as thousands of people, bankers, government officials, railroad executives, industrialists, and ordinary citizens lined the streets to pay their respects to the immigrant peddler who had become one of the most influential financiers in American history. The New York Stock Exchange suspended trading for the day, something that had occurred only twice before in the exchange's history. The major banks on Wall Street closed their doors as a mark of respect. Even government agencies suspended operations to allow their employees to participate in honoring a man who had literally saved the Union during its darkest hour and built much of the financial infrastructure that had transformed America into a global economic superpower. But perhaps most remarkably, telegrams of condolence arrived from across the world, from European prime ministers, Asian business leaders, and government officials from dozens of countries who recognized that Joseph Seligman's death marked the end of an era in international finance. The immigrant who had arrived in America with $100 and a dream had built relationships and influence that spanned continents and affected the economic development of entire nations. Joseph's death marked the end of the first generation of Seligman leadership, but it also provided an opportunity to assess what the 8 brothers had accomplished and how their innovations had permanently altered American capitalism and international finance. Their most obvious achievement was their role in preserving the Union during the Civil War through financial innovations that enabled the federal government to mobilize resources on a scale that had never been attempted before. Without the Seligman brothers' bond marketing, European financing, and international diplomatic activities, the Confederacy might well have achieved independence, and America might have remained permanently divided into 2 separate nations with fundamentally different economic systems. But their influence extended far beyond Civil War financing to encompass virtually every aspect of American economic development during the late 19th century. The railroad network that connected American producers to global markets had been financed largely through their operations. The industrial expansion that made American manufacturing globally competitive had been enabled by their capital and expertise. The international trade relationships that generated enormous export revenues had been facilitated through their international banking connections. Perhaps most importantly, the Seligman brothers had demonstrated that private financial institutions could provide solutions to economic challenges that government agencies and established institutions couldn't address effectively. Their success had proven that innovative financial arrangements could accelerate economic development, facilitate international cooperation, and create prosperity that benefited multiple parties while generating substantial profits for skilled intermediaries. The specific financial innovations that the brothers pioneered became standard practices that continued influencing American and international finance for decades after their deaths. Their systematic approaches to government bond marketing created the foundation for modern public finance. Their international trade financing enabled American businesses to compete in global markets. Their investment banking services provided the capital that funded American industrial expansion. Their relationship banking model, providing comprehensive financial services to wealthy individuals and major corporations rather than simple transaction-based banking, became the standard approach for premier financial institutions throughout the world. Their family-based coordination system demonstrated the advantages of integrated financial operations that could provide superior services while managing risks more effectively than individual institutions operating independently. But perhaps their most significant legacy was proving that immigrant determination and family loyalty could overcome any obstacles and achieve success that exceeded even the most ambitious expectations. The 8 brothers had arrived in America as refugees from European discrimination and poverty, possessing nothing but determination and faith in each other's reliability and competence. Through absolute trust, shared information, and coordinated strategy, they had built the most powerful private financial network in American history, while maintaining family relationships that enabled them to pursue long-term objectives that individual businesses or partnership arrangements couldn't support. Their success inspired countless other immigrant families to pursue similar strategies, contributing to American economic development while demonstrating that America's promise of opportunity was real for those willing to work hard and think creatively about business possibilities. The second generation of Seligman leadership, led by Joseph's son Isaac Newton Seligman and his nephews, continued building on the foundation that the original 8 brothers had established. They expanded the family's international operations, developed new financial services for emerging industries, and maintained the firm's position as one of America's most influential financial institutions. But the second generation also faced challenges that the original brothers hadn't encountered. America's economic development had created much larger and more sophisticated financial institutions that competed directly with the Seligman operations. Government regulation was becoming more extensive and complex, limiting some of the innovative approaches that had enabled the family's original success. Most importantly, the family-based coordination that had been the foundation of the Seligman competitive advantage became more difficult to maintain as the family grew larger and individual members pursued increasingly diverse interests. The absolute trust and shared objectives that had enabled 8 brothers to operate as a single economic organism couldn't be replicated across multiple generations with different experiences and priorities. Despite these challenges, J&W Seligman & Co. continued operating as a major force in American finance well into the 20th century. The firm played significant roles in financing American participation in both world wars, supporting the economic development of emerging markets, and providing investment services for wealthy Americans seeking international diversification. But by the 1970s, the financial world had changed dramatically from the environment that had enabled the original Seligman success. Modern investment banks were enormous institutions with thousands of employees and global operations that dwarfed what family-based firms could provide. Computer technology was transforming financial markets in ways that made personal relationships less important than mathematical modeling and electronic trading capabilities. When J&W Seligman & Co. finally closed its doors in 1980, after 143 years of operation, it marked the end of an era in American finance that had been defined by personal relationships, family loyalty, and innovative approaches to complex financial challenges. But the principles that had enabled the Seligman brothers' success continued influencing American business and finance long after their firm disappeared. Their demonstration that family